Dear investors, in this edition, we would try and address some of the popularly held beliefs and see if they actually help the investors or result in suboptimal outcomes over a period of time. So we will interpret beta. We will talk about that it is continuing to be time for alpha, fund flows, and of course valuations and outlook for the future. Now the first topic, how do investors interpret a stock's beta? Beta is a measure that reflects how strongly a stock price tends to move in relation to the broader market movement. It helps investors estimate how much a stock might amplify or dampen the market up and down when added to a portfolio. A beta of 1 for a stock means it has been as volatile as the broader market. If the index moves up or down by 1%, so should this stock on an average. Betas larger than 1 indicate greater volatility. So if the betas are 1.5 and the index moved up or down 1%, the stock would have moved 1.5 on an average. Beta less than 1 indicates less volatility, and the outcomes would be similarly there on the opposite side. So when compared to index performance, a lower beta stock portfolio is expected to rise or fall slower than the index. If one is a long-term investor and is tuned to the fact that most global indices have risen over a period of time, then having a high beta portfolio may improve the return outlook and vice versa. The key to achieve good long-period outcome is not to bring down the portfolio beta when the chips are down, because then when the markets is reversed, there would be portfolio drag. Over time, consistency in maintaining high beta should result in much better outcomes for the investors when absolute performance is measured at a time when index is point to point higher and has been rising for some time. Higher earnings growth spaces should be expected to have higher beta. If one believes that market follows earnings growth, then higher growth in earnings may imply that stock portfolio performs better than the market. It might hence result in higher beta. A Nasdaq with a higher representation of innovative tech companies with higher growth quotient is more volatile than S&P 500 but has historically delivered better return outcome. Calculating from the peak of the tech bubble, from Jan 2000, S&P 500 has delivered 4x returns, while Nasdaq, which has been more impacted by the tech bubble burst, has, with all its gyrations, delivered 4.7x returns. In this light, it does seem that for a return-focused investor, higher beta may result in better return outcomes. Now, the outcomes can improve further if the causes of higher volatility and beta are analyzed, retaining the favorable ones analyzed and eliminating others. For example, higher beta on higher earnings growth is often viewed positively, and our belief is that markets follow earnings growth. However, higher beta on account of higher news flow association with the stock may not be viewed positively. Inconsistency of earnings can lead to higher beta and may not again be viewed positively. Something like this happens with commodity names. Leverage can accentuate earnings volatility and hence beta, and this may again work in one period and not in the other. We believe that investors should look at reasons for higher beta and choose names where reasons for higher beta are good, such as higher sustained longer period earnings growth for favorable outcome. Now, while beta can offer useful information when evaluating a stock, it does have some limitations. Beta can determine a security's short-term risk and analyze volatility. However, beta is calculated using historical data point and is less meaningful for investors looking to predict stocks' future movements for long-term investments, because a stock's volatility can change significantly over time, depending on company's growth stage and other factors. Low beta stocks can fall slowly over time and have a bad absolute outcomes. So while there is a lot of focus on beta, a lot of it is on wrong reasons. Beta gets higher focus in a period when the indices are not performing well and is associated with funds which experience a larger decline in such periods. Now, this creates a perception that low beta is in some ways better than high beta. However, over a longer term, as markets have historically moved upwards, a reverse may also hold true in certain phases. Coming down to the next topic, it continues to be time for alpha. Q4 result season is over. While the index earnings growth was better than expected, companies in our house themes have shown significant growth. Our belief is that market follows earnings growth. Month of May reflected relatively better performance of our investee companies compared to the index. We would continue to focus on spaces where earnings growth quotient would be maintained at a higher level. In this period of disruption and innovation, when several new spaces such as new tech, electronic manufacturing, renewables, electric vehicles, AI, etc. are emerging, we think chances of delivering alpha by growth-focused investors is favorable. As we go deeper into the new fiscal, quarterly results would have the support of low base of financial 25, and this would enable companies and overall the market to deliver a low double-digit earnings growth versus a single-digit earnings growth seen in FY25. We expect our investee companies to deliver significantly better than index earnings growth in this period. Fund flows. While over the last 2 years, FPIs have been marginal net sellers, over the past 4 months they have been net buyers. In such periods, markets have historically seen a bounce because domestics are secular buyers, and the same has been observed from March. Now, Brazil, the only emerging market to see inflows in Jan and Feb period, continued to witness inflows. Domestic flows have been slowing down in the new calendar year, but we sense that the month of June has seen a revival. In terms of FPI moves across sector over the last 1 year, we find that relative weight in industrial, healthcare, materials and IT has increased, while it has declined in financials and consumer discretionary. However, FPIs have now become relatively smaller participants in the Indian equity market, and domestic participants are now playing a more prominent role. Over the last 2 years, FPI investments have been close to zero net, while domestic institutions have invested over $100 billion net. Now, domestic funds continue to see inflows. However, the pace of money flow reduced considerably in the month of May. A good thing is SIPs hit an all-time high and provide continued participation and stability to the market. Overall, we are looking at SIP percentage of the AUM increase over time for the industry. Coming down to the last topic, valuations and outlook. Markets have recovered significantly from recent lows. Many stocks in spaces such as defense and capital markets have registered a new all-time high. Strong Q4 results versus expectations improved sentiment. DXY index is sustained lower than 100. US dollar is relatively weaker, and all of this is positive for risk and growth assets. At the current juncture, though, some of these positive indicators have seen some worsening. Crude shot up on Israel attack. We thought the rise in crude prices would prove temporary, as there is ample crude supply and OPEC had only recently increased production. Moreover, none of the Iranian crude facilities have been impacted, and after the spike to $78, crude has fallen back. In any case, Iran is a country under sanctions and the crude exports are curtailed, which will make it possible for them to keep the export volume through other fields if one gets impacted theoretically. Happily, by now this event is probably behind us. We are not worried about the impact on the Strait of Hormuz because it would potentially affect Iran's relations with several other Arab states, and our simple thought is when times are bad you need more friends rather than create more enemies. Now the next point is supply of paper is getting stronger. Stake sales by promoters, QIPs and new IPOs are all gaining in momentum. This is absorbing a lot of liquidity with institutional investors. While a lot of the funds come back to the market over a period of time, for example, stake sales by promoters is invested into some real estate but mostly come back into financial assets, it takes time. While companies may not be needing cash, sales by promoters, private equity, etc. is impacting liquidity. Now, the other point is Trump's final tariffs would be rolled out over the next period. July 9th is the date before which the final tariffs would be rolled out. While as we speak, there is news which suggests that it can get postponed as well. But that said, while US just imports about USD $80 billion worth of goods from India, the value add quotient there is just about US dollar 20 billion. This is a small part of our 4 trillion GDP, and the impact of any tariff would be marginal on the negative side. While, for the country, while some companies may get negatively impacted. On the positive side, if we were able to gain preferential access to the largest market globally, it can be very positive for the Make in India initiative of the government. Hence, our keenness in doing a deal with the US. US has tightened the trusted vendor definition, and if it is approved by both of their houses and becomes law, it would help Indian exporters. This is something to be looked for. While we think that the above factors may eventually be resolved on the neutral to positive side, there is a possibility that market may witness a period of consolidation till these issues are resolved. Now, high earnings growth stocks where no fundraise is there either by the company or by the promoters could see relative strength, while others could consolidate. Given our view that the recent crude oil spike should be temporary and the outcomes of trade negotiations with the US would result in positive outcome for India versus other countries, we could see positivity build in the markets and it may improve as these uncertainties try to subside. The current period of consolidation may offer investment opportunities for investors with a long-term perspective. Thank you. Happy investing. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.